Hello, everyone. This is Joseph Trevisani from Worldwide Markets. It's been a while, almost a year, since I've done a webinar for FX Street, so I thank you all for attending. It's a great pleasure to be back, and it's a great pleasure to have all of you listening. And once again, I thank FX Street and Vicky and Maud and all the others there for the opportunity to do this. There's really only one topic in the world these days, at least in the financial and the markets. And that, of course, is quantitative easing and its various permutations around the world. You have a situation now, and this is such a vast topic because it involves motivation of the central banks, it involves their mandates, it involves politics, it involves the currency markets, it involves all of the trading markets. It involves you and I. It involves our savings accounts. It involves our retirement accounts and almost anything else. So I had to sort of choose a framework for discussing this topic. It's not exactly a topic which is uncovered in the media, but in most of the media, at least the financial media, the tendency is to cover it on a very narrow basis. Will the Fed, as before the last FOMC meeting, will the Fed announce another QE program? What will its effects be? Will it cause inflation? Along those lines. Now, I'd like to say that while you're listening, and hopefully I would like to be listening also, although that's a little more difficult, what I'd like to say is that for everyone, if they have any questions, and thank you very much, if anyone has any questions, or any comments, please just type them into the window, the chat window, and I will be glad to digress and talk about them and answer any questions I can. Of course, there are many questions that I can't answer, but I'll do my best. I've always thought in these webinars that an interactive webinar, to use what's becoming an antiquated term at this point, it makes for far more enjoyable and far more effective discussion of any particular topic. After all, I am hardly infallible, and I am hardly all-knowing. And there are many other items out there that I either may miss, or misstate, or simply forget to cover. But to go back to the topic. The Fed has now done actually the government in the United States, and I'm going to focus primarily on the United States. There are two reasons for that, and I'll talk about them briefly. China, which is the second biggest economic bloc in the world, behind the United States, as far as the economy goes, and a specific country economy here now. Of course, if we're talking about economic blocks, then the European economy is actually first. The EU economy is actually first. It's 27 nations, followed by the United States, followed by China, as far as size goes. If we're talking about national blocks, then of course it's the United States, China, and I believe Japan is third. In this case, I think it would probably works best to talk about the U.S. and China as both national units and economic blocks, and the European Union less so. The problem is, as we've seen over the past 3 years, they're lacking most of the attributes of a unified economic bloc. They have a currency, they have a central bank that has limited purview, they do not have a fiscal policy, and God knows they do not have a unified political entity. Therefore, they are not really operating as a unit in most of the things that we're talking about here. Certainly, when it comes to the effect and the institution, meaning instituting of quantitative easing and other block-wide financial policies, or monetary policies in this case, they really don't have a unified policy. They have a unified interest rate, and they have a central bank. but they do not and have refused the ability to do the types of intervention that the United States has done through the Fed and that China has done through various other types of domestic institutions. So just to dispose of China briefly, and China is a topic unto itself, and that's why I'm not really covering it at this webinar. One, the Chinese economy is relatively opaque as far as the accuracy of its statistics, the choice in its statistics. You except for a few from HSBC, you are limited to Chinese government statistics. China is an authoritarian, a government, whatever other terms you want to put upon it, I will leave to the various choices. And their system works a little differently. Their method of supporting their economy tends to be through loans. The central bank orders loans out into the economy, and therefore they go. China is a relatively unbalanced economy in the sense that it has depended for the last 30 years on export growth, not on domestic consumption. It has been unsuccessful in fomenting a greater degree of domestic consumption. Therefore, it is still an export-driven economy. That makes it extremely vulnerable to what appears to be a worldwide slowdown, especially in the United States and in Europe. Therefore, I'm going to leave China perhaps to a future session, and we have another one on the 18th. Perhaps China would be a good topic. China is a difficult topic. I am not a China scholar. However, we will deal with that in the future. So, for the Fed now in the United States, which is what I'm talking about, there have been 3 and really 4 if you go back to the Bush administration's attempts at quantitative easing, or not attempts, but actual quantitative easing. The result has not been a roaring, booming, or even thriving U.S. economy. The argument that has been made all along, and one that I will make to a certain degree as well, is that certainly the first 2 or perhaps 3, counting the Bush administrations, quantitative easing, whatever you want to call the policies, were successful in a sense that their goal was to save off catastrophe, which, since we did not have it, they have succeeded in doing. They have not, however, and I do not believe that this one will manage it either, sponsored economic growth in the United States. However, first of all, let us look at, now it has been said by many people, in fact by most people, probably except for me, that this quantitative easing policy of the Fed, $40 billion of MBS a month, forever, or at least until the Fed determines that forever has arrived, and forever, unlimited, open-ended, does in fact have a limit. What has been the effect? I'm going to look at some of the specific markets as to what the effect has been. Now, prior quantitative easing policies had a great deal more effect. One, they involved a great deal more money, and they were to some degree a surprise. And we all know if you want to get an effect from markets, surprise them. Everyone will fall over themselves to get in line with the new policy and with the old adage, don't buck the Fed. So this policy was long anticipated, and I'm going to show you some of the effects of this anticipation. The effect has been that in the markets where the Fed is having and has asked for its direct effect, that this QE policy has affected those markets. But in the markets where there is relatively little spillover and little design, actually, the main effect was anticipatory, buy the rumor, and sell the fact. But let's look at the specific markets. this quantitative easing program, and then at the very end, I will attempt to draw some conclusions from this policy and the economy going forward. So let us be specific here. This policy, this particular QE policy, now it was my opinion that I wrote into a number of columns that although everyone is considering this policy open-ended, I really don't. Yes, it is open-ended in the sense that the Fed has neither put a dollar limit or a time limit on what they're going to do. They have instead put an unemployment limit on it. They're targeting unemployment. The Fed must, in order for the Fed to do what it does, remember, one of the hardest things to realize about the Fed is the constraints and the goals and the mandates and the responsibilities of the people at the Fed, of Mr. Bernanke. They are not supposed to be unlimited policymakers. The only unlimited policymakers are the politicians. The politicians in the American system are given the responsibilities, both executive and legislative, to pass laws. It doesn't specify what those laws are, and within the context of the Constitution, they can do whatever they want. Now, there are political restraints, of course, but they are the ones who are the unlimited policymakers. The Fed is not. The Fed's responsibility is to act within, and this has been said 100 times, there's nothing new, but it's something which bears thinking about. The Fed's responsibility is to act within its mandates as provided, essentially, by derivation from the people through their representatives in Congress. That mandate, as we all know, is inflation and unemployment, or at least employment, to provide the best type of an atmosphere for that. I forget what the specific wording is. So for whatever the Fed is going to do, it must be justified by reference to these two factors, these two mandates. Clearly, inflation is not a part of this picture right now. Mr. Bernanke and the Fed has been right all along. They can do whatever they want. If there's no demand, there's no inflation. And relatively speaking, that is the case. We are probably pretty far from worrying about deflation, at least in the United States, which was the case early on in the aftermath of the financial crisis, when the Fed was acting to do everything they could. But now we are not in that condition right now. So the Fed, whatever it thinks it's going to do, it must justify it by reference to one of its two mandates. In this case, it has been referencing specific, which has never happened before, unemployment. Now, the Fed hasn't come out and said that, we need to get unemployment down to 5% or 3% or 7%. And that's deliberate, of course. That gives the Fed a reason to get out of the policies and stop them whenever it feels that it's moving in the correct direction, regardless of the cause of that. It could be, just take a hypothetical. We have an election in a month in the United States. Without speculating on who is going to win or who would be better, let us just say that the election takes place and there is an enormous love fest in Washington. Everyone suddenly agrees on the correct policies to follow, and not only that, they know the correct policies. Again, this is a thought experiment. In that case, and those policies were enacted in a miraculously short time, and the economy starts to recover. All the signs start to move in the right direction. Within a few months, the Fed would discover that its unemployment mandate or employment mandate had been met, and it would retreat from its policy. So the clue, as with all other Fed policies, and the reason the Fed has never, unlike the European 2% mandate on inflation or 2% toll. The problem with the 2% mandate or a 2% goal in Europe, as with the 3% deficit and 60% debt limit, which were supposedly part of the EMU, irrevocable, ironclad, until they needed to be discarded. That's the problem. Those hard and fast mandates, those guidelines, are only good until the policymakers decide that they need something else under the prodding of the politicians. Therefore, the Fed has, I think correctly, as long as it's talking about unemployment, has not given a specific target, nor will it. So we can be sure that in that hypothetical situation, the Fed would stop buying as soon as it saw things moving. The same with this unlimited, open-ended QE policy. It's my contention that the policy is limited in the sense that its effect will be for increased scrutiny of because you have now an absolute factual determination on what the Fed's view of the economy is at every FOMC. We won't have to parse the words. We won't have to see which adverbs they changed or which adjectives they added in the FOMC statement. All we'll have to know is are they continuing to buy MBS paper. So the entire policy of the Fed has been distilled into one act. But that also means that almost any interpretation of the economy relies upon this one Fed decision. So the leeway for the Fed's policy and the Fed's reading of the economy is now much narrower than it used to be. You used to have to speculate, especially under old Alan Greenspan, who was so much fun. You had to speculate on what the Fed's policy was going to be. You don't now. No matter what, if the economy is improving, if you get better initial jobless claims, if you get a better non-farm payroll, if you get better income, and the Fed still continues their policy of buying MBS paper, then the judgment of the markets will be that things are not really that good and the Fed knows something. And the reverse will be true. If the economy is getting worse, or it appears to be, and statistics are still deteriorating, and the Fed suddenly stops MBS, you will have a burst of optimism or something. So the Fed is constantly one decision. That means that this supposedly open-ended policy FOMC to FOMC. It is constrained somewhat every 6 weeks. Every 6 weeks, everybody's going to be watching the figures and see what the Fed does. So the unlimited aspect of the Fed is largely the same type of unlimited or very extended interest rate guidance they have given. Yes, the Fed has said they keep lengthening the period that they're going to have extremely low interest rates. But does anybody believe? Even now, I think they're now out to February 2015. I mean, at this rate, they're going to be out there when I retire, which is a couple of years beyond that. We're going to have low interest rates forever. Forever. However, forever is very limited. As soon as the economy starts to recover, forever will be defined. And if the economy starts to grow before 2015, then interest rates will, and inflation especially, starts to go up, and unemployment comes down, then the Fed will define forever as a good deal shorter than eternity. So all of these policies, even though the Fed has said they're unlimited, they keep extending the interest rate guidance. Those are psychological factors. They are not factuals. Factual factors does not sound very good, but they are not facts. They are trying to convey to the market that the Fed is not going to let this blow up within the best of its ability as defined by monetary policy, which is essentially all they can really do. That psychological factor will be withdrawn whenever the Fed thinks it's necessary. Okay, so now let's look at some specifics for this QE. Yes, as far as this comment about 180, I heard. Yes, I know, and I know you've heard this from me before, but my favorite comment from Mr. Greenspan, of course, is, or was, he's still alive actually, he's well into his 80s, was that if you clearly understood what I've said, I must have misspoken. In a way, that market, that comment gave a lot more credit and was a great deal less central planning like as what Mr. Bernanke's been doing. Now, Mr. Bernanke, of course, and the Fed people will make the argument that certain times call for desperate measures. I do not actually believe that, but I'm not here to pass judgment on the policy. Although I will a bit at the end, I suppose. Yes, I heard that someplace, Carlos, I see your comment there. I heard that someplace there was a gas station that was, as a political, of course, comment, was selling gas at the same price of almost 4 years ago when President Obama took office. But I think that was a political comment on Mr. Obama's policies. No, we're still on the 10-year yield. I apologize for that. Yes, there were lots of old ways of determining what Mr. Greenspan was going to do. Made for more fun in the markets, I guess. What we forget is that one of Mr. Bernanke's tenets when he came into the Fed was to increase the transparency of the Fed. He thought that would be beneficial to markets, and he has done that right down the line. He has certainly kept that idea running at the Fed. Except for extraordinary circumstances during the financial crisis, the Fed has largely avoided surprising the markets. Okay, so let us look. This is the 10-year yield. The goal of this QE policy is very simple, and it's very specific this time because they're only buying MBS paper. Now, it's also true that the Fed is buying somewhere between, I think, 50 and 60%, if I remember, of the new issues from the United States Treasury. That is a topic which, if you think about it, is a very strange topic. That means, of course, that you are paying off your credit cards by issuing your own script. It's no different. I've made this point before. The government issues debt, and the government buys its own debt and calls it a sale. That's what's happening right now. But the implications of this, and this is the only time I'm going to touch upon this because it becomes very political, the implications of this are twofold. One, that despite what you're hearing, that people still regard the U.S. as the safe haven, that appears not to be the case. Otherwise, the Fed would not have to buy half of the issues of Treasury. It also implies, this is the dangerous part, that if the Fed stops, rates go up, and they go up sharply. Because the Treasury is running $1 trillion deficit every year, an incomprehensible number. Remember what we're dealing with. We are dealing with confidence of markets. The Fed, the Treasury, the U.S. government has not lost the confidence of the markets, that it can disappear very quickly. My guess is if the Fed stops buying this debt, rates will shoot up. The Treasury will have much more difficulty funding the U.S. deficit, and that is when things get ugly. Now, just like with the Fed now, if that's the case, or the Fed is afraid that's the case, or thinks it might be the case, the Fed will continue to buy U.S. Treasury to prevent that from happening, regardless of anything else, for the very same reason that the Fed is buying MBS paper now. Yes, the price is absolutely artificial. Absolutely. If the Fed is buying half the treasuries, does that sound to you like that's a functioning market? No, of course not. Okay, well, back to this. This is the 10-year yield. Guess what date this is right here at this peak? Nobody wins anything for this. It's September 13th. I know it says 14th, but it's actually right about here. So, in this specific market that the Fed targeted, the MBS market. Now, this is not MBS, but of course they're going to deal the same way. In the credit markets, the Fed still has credit, power, and effect, as you would expect. Now, the goal of the Fed is very simple, to bring down interest rates. The whole virtuous circle that they're trying to do is that you bring down interest rates, people buy houses, house prices rise, people feel wealthier, they start to buy things, you start up the virtuous circle. It certainly hasn't worked up until now, and I don't believe that it will. People do not buy houses because there's a 0.5% difference in a 30-year mortgage rate. They buy houses because they think they can afford to pay the mortgage for the next 30 years. That means a job. The argument would be that at the margins, you get things moving. The margins meaning the margins of the housing market. You get things moving. I mean, I heard Arthur Levitt on Bloomberg Surveillance yesterday, and he was talking about housing formation, family formation. That there is, because there have been so few houses built over the past 5 or 6 years, 6 years really, there is a dearth, a lack of housing. And it's true, nobody's been building housing. If you look at I don't have any housing stats up here, but if you look at the number of new homes built, it's far below replacement value and new families, people who want to buy homes. The problem with that analysis is that it assumes a certain rate of housing formation, of household formation. The factors that go into household formation are psychological and economic. Can you find a job? Do you feel that you'll be able to have a prosperous career? Can you buy a house with your view of the economic future of the country? If that changes, then the rate of household formation changes, and the need for new houses also change. People continue to rent. They live in their parents' garage, whatever they do. Now, I think he's right that there is a lack, dearth, an underbuilding over the past several years. But until the economy and jobs start to move, I don't think you're going to find a great return to housing formation. People need to have jobs, by and large, before they buy a house. Now, the Fed knows this. If I remember, I read someplace that Mr. Bernanke had, when he was going to school and taking the SATs, which was actually not long before I was taking the SATs, which is the American college entrance exam, a general college entrance exam. The total you could get if you had a perfect score was 1,600. They had a math and a verbal in those days. They now have a written section also, so the total you can get is 2,400. My score will remain unremarked, but if I remember reading, Mr. Bernanke had very close to a perfect score. So Mr. Bernanke and the people on the Fed know very well that their policies are having, and can only at best have, a marginal effect on the economy. So the question is, why do they still act? because their mandate tells them that they are required to act in the best interest of their mandates. And there's no denying, and I would agree with this as well, that there is a marginal beneficial effect. And that is, if you will, the philosophic read that this current MBS program is built on. It's not going to make things worse. It may make things a little bit better. And besides, there isn't anything much else that we can do. It is difficult for anyone, any human, with that type of power not to act. It's my contention that in the state where we are now, it would be better not to act. But that clearly is not the philosophical tact, rationale, logic, reasoning of the FOMC board. And you can understand, I can understand why. Now, so at this point here, you can see very well, we're going to move on to another chart, that I'm going to answer the comments in a second, that in the credit markets, the QE announcement, despite its great anticipation, everybody knew this was coming. It was hardly a surprise. Had its effect. This is the generic 10-year U.S., and you can see the effect we've had. And I believe it's a bit lower right now. I'd have to check, though. So that is the credit market effect, as expected. Now we're going to look at the effect of the Dow. Okay? This is the Dow. This line right here is, guess what? Also September 13th. Now, the MBS policy is specifically designed for the housing market to provide the marginal benefit that I just spoke about. But in the past, Mr. Bernanke has spoken about the wealth effect of the stock market. And since it had an effect on the Treasury market that we just saw and the other credit markets, those markets are greatly affected by cost of funds. Since if fund costs are lower, credit costs are lower, then everyone has a higher profit margin. Remember hearing on the way in this morning, Bank of America, which bought Nationwide back in the financial crisis, I think it was Nationwide or maybe Countrywide, a big mortgage broker. The price of the bank and other financials as well is up 60%, Bank of America, in the past year. Why is that? Because they're minting money. Because the spread on their mortgage business and other things is huge. Because the Fed is keeping rates artificially low. It doesn't matter, one, that the mortgage rates are at historical low. What matters is the spread that the bank pays over its own cost of funds. Now, of course, there's a big issue here. And the big issue is mortgages tend to be 30 years or 15 years, and the funding is much shorter than that. If rates start to rise, all sorts of problems start to happen. So again, the Fed is building itself a box that it's going to be difficult to get out of. Okay, let me just look at one or two of these comments. But again, you can see here, these are the markets where you have had an effect from this well-anticipated QE policy. The effect continued despite the very clear anticipation in other markets. Okay. I'm just looking at this one, Carlos. Yes, I hesitate to call, to make some of the comments you are, but it is true. There is no doubt that this policy, and for me, the crux of the problem is that the Fed is buying half and more of government issues. This is not being spoken about anywhere. The Fed would rather have everybody ignore it Certainly the administration would rather have everybody ignore it. Certainly Congress would rather have everybody ignore it. But when you run these types of deficits, it is far easier to pay them off yourself, which is what's happening, and not pay them off to fund them yourself. So where will the motivation be in Congress to shut down these types of deficits if they don't have to? And if the Fed is going to continue buying. Now, of course, the Fed can stop. Mr. Bernanke can say, we're not going to buy anymore. But again, he's in the box. The box is that if he does that and starts to wind things down, there's going to be enormous pressure and enormous danger from the rising interest rates that this will cause. Pressure on the economy and pressure on the federal government. So the box is there. It's just no one's talking about it. Okay. So those are the items. There's one more. That this QE policy, this is chart number 15. Okay, hold on. No, the numbers are not moving. These are static. These are static graphs. These are all screenshots. I have so many graphs here, and I'm knowing my usual way with the webinars, I may not get through them all. But there are so many graphs here that it would be much more cumbersome. Many of them are from Bloomberg. Some of them from our own trading system. They would be much more cumbersome if I had to go back and forth and create these graphs. So I did screenshots. Okay, this is a chart of gold. It's from our trading system, the WWM trading system. As Tom Keene likes to say, shameless plug for my company. This date right here, no guess, September 13th. Gold, interestingly enough, although for different reasons that I'm going to go into, responded to the new QE program exactly the same way. Now, the credit markets and the equity markets have substantive reasons for responding as they did, even though the move was anticipated. For the credit markets, the Fed is out there not only buying MBS, but it's also buying treasuries. Okay, well, if it buys these things, the price is not going to fall. It's there as a floor for the market that keeps the rates high. For the Dow, and for other equities, if rates are coming down, that improves the profitability of so many companies. Therefore, there is a reason, and this is aside from whether or not there's liquidity flooding into the markets, that people are buying it up because they have nothing else to do with it. There's probably some degree of that too, although it's very difficult to quantify that. Gold, however, is not really the case. We have a different rationale here, one that I would consider far more psychological. For me, gold runs on a tripartite rationale. The first is, as I call them, the Armageddonists. The world's about to end, let's buy gold. That's a portion. The second are the inflationists. We're about to get inflation, let's buy gold. The third is simply trading. Gold is going to keep going up for whatever reason, let's buy gold, we'll make a trading profit. For gold, inflation, even if you're anticipating inflation much in the future, there is no inflation now. However, for the other two, and certainly with the current resurgence again of the problems in Europe, which really only disappeared in August because everybody was on vacation. That's it. There was never any logic to the idea that the Europeans had solved their problems, and they haven't. But everybody was on vacation down on the beaches in southern Italy and in Greece, very nice places. So nobody did anything in August, but now we're right back where we are. So in addition to the Fed's purchase of MBS, it's my idea that gold is rising largely for reasons not connected to. There may be some of the Armageddonists who say that if the Fed is doing this and they're continuing to buy, then we're getting that much closer to doomsday and let's buy gold again. But I think more of the gold move higher has been related to the situation in Europe and its resurgence. And we're not going. There's a lot there to talk about. Maybe we'll cover that in the next. Okay, let me share the gold chart again. Hold on. Let me do a recapture again. Okay, as the person asked. Okay, I'm going to do a app capture again. Okay, I hope you can see the gold chart. I just put it up. Yeah, well, there's a lot of fun stuff to talk about here, but I'm going to try and keep it a little bit limited. Okay, so that's the gold chart, and I hope everybody heard it. Excuse me, come on. Sorry, folks, I'm trying to get the gold chart back for everybody, and it is being a little difficult. Okay, there. Can everyone see the gold chart? Somebody let me know if they can see the gold chart. I can't really see it. Okay, we can see the gold chart. Okay, just to repeat, this is FOMC. This is hold on. Sorry, folks. As I've said many times before, a great technology, but not quite perfected. Okay, this is the FOMC day, 9/13. So certainly there was an effect in that. And it would be hard to say that there is, it would be impossible to say there's actually no effect from what the Fed did. But for me, it's a lot more psychological than anything else. The factors for the T-bill and the Treasury, the credit, and the down markets are actual real effects in that the new QE program will have some real effect on interest rates, and therefore that bears on the actual economics, the financial economics of the market. Those two markets. That's not true here. Gold is a great hedge against inflation, but this isn't going to cause any inflation. People may buy gold because they think the world is going to end, but that is really not. Yes, I'll make the chart window bigger. How's that? That should be better. Okay, and I'm going to minimize that. Okay, so here we go. So that effect here, as I said, although you did have a striking effect there, to my mind, it's a trading effect and one based on Europe. I would have to correlate that with some of the announcements in Europe, but anyway, there is an effect here. It's just less so, and it's more of a trading and psychological effect. Okay, now let's look at some of the markets that really have not moved or neutral based on this, even though you might expect them to. The first one I'm talking about is Euro. Okay, now this is the Euro chart. This is the last FOMC back in beginning of August, and this is the FOMC right here. It's this one right here, this chart. Now, this is twofold. One, it's the European vacation. No news out of Europe. There's no doubt that had an effect on the euro. Bad news is good for the dollar, and no news is good for the euro. And so we saw that. But there was also increasing speculation throughout this time that the Fed was going to do something. As a matter of fact, if the Fed hadn't done anything on the 13th, my guess is we'd be well below 13,000 right now. So if you want to look for a political effect, although the Fed is certainly justifying it through referencing the employment market, you definitely have a political effect. But since, now if this is all driven by an actual, how shall we say, by a greater degree of liquidity, chasing profits, more people trading, looking to make profits in the currency markets, as they say, the devaluation of the dollar and all of the other supposed, hold on, I'm seeing something. I think my guess is, oh dear. I am being told by Vicky that we are close to out of time. This is sort of my history with these webinars. So let me just finish. Okay, Vicky, I see that. The result of this is that it appears to me that there is no actual liquidity effect in the trading markets. That means supposedly hedge funds or others now have greater access to dollars, and they're using it to chase trading profits because there's nothing else to do. So they're opening up. There's a greater volume going into the currency markets because of QE. That is not borne out by this chart. What you have here is buy the rumor and sell the fact, with, of course, a return of problems in Europe. So it appears to me that the fears, and then the thing that we've heard before about many of these QE programs in the United States, that they create excess liquidity that works its way out to some degree into the trading markets and creates bubbles in commodities, in other things, does not appear to be true for this QE program. Here's another point of that. This is the oil price. Okay? Same chart, although this time I took it out to the prior FOMC and then third week in June. This is the FOMC. I'm sorry, that's the wrong date. That should be 8/1, not 9/1. And again, we're seeing the same thing. This is the FOMC right here, and we've seen a decline. So again, you are not getting the liquidity effect in these markets from QE. So the effect from this QE program seems to be far more limited. Now, you can make a number of reasons for this. One, I would say that in any market action, you have a law of diminishing returns. The more you do a thing, the less it has an effect. And that's certainly the case here. One of the great drivers from the early instances of QE was the fear of inflation. That all of this liquidity was going to create inflation. Well, that drove gold. It drove all sorts of commodities. It drove oil. It drove the dollar down. We're not seeing that. We have not seen inflation. Therefore, that entire rationale is quiescent. It's not in reality. There is no inflation. So you have a diminishing effect for that reason. In addition, the amount of QE this was not a surprise. I mean, the fact of it was not a surprise. And it's very limited. I'm sorry, $40 billion a month of MBS is not much. It's not going to have much effect. It's only going to be specifically targeted to interest rates. I mean, the Fed is telling you that something needs to be done, but it is doing the least amount that was probably necessary to keep certainly the equities from crashing. Think about that. The Fed, although it appears to be doing a great deal, in my mind, is actually doing very little. It's doing the minimum necessary. The Fed is the only entity out there acting. It may continue, although I hesitate to think what the real result will be. There's very little more the Fed can do. If we end up with, as they say in Britain, a hung parliament in the United States, we're in for, I think, a rough ride for the next 4 years, depending on what happens with the election. Okay, folks, I know that I am not a fan of this policy either. I think the issue with the policy is this, that it is simply delaying and denying the necessary adjustments that are part of capitalism. They're unpleasant. They're a bit like exercising, you know? If you don't get out there and exercise, no pain, no gain, you don't get improvements. We have a similar type of cleansing policy necessary here, and the tools given to the current bureaucratic entities are such that they can keep things afloat. They can keep juggling. But juggling does not last forever. Okay, folks, I thank you very much for attending. A little out of practice on this, so next time we will keep to a stricter examination of the topic. I hope you all had a good time. I hope it was interesting. I thank Vicki and Maud very much for putting it on. I will put my email address in here. If you have any questions, please send me an email, and I'll do my best to answer them. My typing is, as usual, poor. So it's jtrevisani@worldwidemarkets.com. Thank you all very much for attending, and we'll see you again shortly.